Over the next 18 months, nearly 1 million homeowners will receive a letter that could push them into selling their homes. The shocking part? Most of them still believe everything is fine. Whether you already own a home, you're trying to buy one, or you're renting and wondering if you'll ever afford your own place, what you're about to hear will completely change the way you view the UK housing market. Because this isn't just a slowdown. It's a full-scale restructuring of who gets to own property in the UK. By the end of this video, you'll know exactly which side of this divide you fall on, and what you should be doing about it. But first, subscribe to UK Housing Report for the real story behind the headlines no one else is talking about. Let's get straight into it. Here's the truth no one wants to acknowledge. The UK property market has split in two, and the two halves are moving in completely opposite directions. In northern cities like Newcastle, Leeds, and Manchester, homes are selling faster than they have in years. Some properties go under offer in less than a week, often with multiple buyers competing for them. Prices in the northeast have jumped almost 8% in the past year. Meanwhile, in London and across the southeast, everything has slowed to a crawl. Asking prices are slipping month after month. Sellers are watching their listings sit untouched on Rightmove, and those who finally do get an offer are accepting far less than they expected. Just think about the price gap. A 3-bedroom house in Newcastle may cost around £180,000. Move that exact same house to outer London, and you're looking at £450,000 or more. The disparity has become so extreme that many people are questioning whether staying in the south even makes sense anymore. And this shift isn't about lifestyle or personal preference. It's simple math. Yes, London salaries are higher, but not nearly high enough to justify mortgage payments that are double or triple those up north. Add in commuting costs, council tax, and everyday living expenses, and it becomes clear that someone paying off a £200,000 mortgage in Manchester can enjoy a better standard of living than someone battling a £400,000 mortgage and an exhausting commute in London. People are finally waking up to this. The data lines up perfectly. Supply in London has risen almost 19% compared to last year. More sellers are flooding the market, trying to offload their homes. But the number of completed sales has dropped 28% year-on-year. More listings, fewer buyers. A classic standoff. And in a standoff, prices always go one way, down. But things are about to get much more serious. Because between now and the end of 2027, around 800,000 homeowners will see their fixed-rate mortgage deals expire. These are people who locked in ultra-low rates of 2% or 3% when borrowing was cheap. Now they're coming off those deals and facing rates of 5% or more. Let's make this real. If you borrowed £250,000 at 2%, you'd be paying about £1,120 a month. Remortgage at 5%, and that jumps to £1,460. That's £340 more every month, over £4,000 extra each year. For families already stretched by soaring energy bills and food prices, this isn't just tough, it's impossible. And the nightmare doesn't end there. If someone fails to remortgage in time and falls onto their lender's standard variable rate, they could easily face 7% or 8%. At 7%, that same £250,000 mortgage jumps to £1,750 a month, £630 more than before. That's an extra £7,500 per year in interest alone. For tens of thousands of homeowners, especially those who bought at the peak in 2021 and 2022, this simply isn't sustainable. They maxed out their budgets when rates were low. Now they're being forced to choose between finding hundreds more each month or selling before things get worse. This is exactly why supply is rising fast in certain areas. People aren't choosing to move. They're being pushed out. And while all this is happening, there's a huge generational divide unfolding. If you're over 65, there's a 61% chance you own your home outright with no mortgage. You're watching prices fluctuate from a safe distance, with no monthly payments to worry about. But if you're under 45, you almost certainly have a mortgage, and you're taking the full hit of rising interest rates. Younger homeowners hold most of the UK's mortgage debt, so they're absorbing almost all the pain. It's not about blame, just timing. But it means one group is being squeezed to the breaking point while another is barely affected. Now let's talk about landlords, Because this part is dramatic. Last year, 19% of landlords sold properties, while only 8% bought more. That's a massive net loss of rental homes. And this trend is accelerating. Surveys show that 41% of landlords are planning to either reduce their portfolios or leave the market entirely. Nearly half the landlords in the UK are preparing to exit. Some are tired of the hassle, but most are being pushed out by the numbers. Mortgage rates have doubled. Rents can't rise fast enough to match. New regulations are piling on extra costs and risk. The Renters Reform Bill eliminates Section 21, no-fault evictions, meaning landlords now need a legal reason to evict. That's great for tenants, but it's a massive risk for landlords. If a tenant stops paying rent, the eviction process becomes longer, more expensive, and far more uncertain. Then there are changes to furnished holiday lets coming in April 2025. Tax benefits are being stripped away, making short-term rentals far less profitable. Many landlords are deciding it's simply not worth continuing. And this landlord exodus has created a strange double effect. Rental supply is shrinking, pushing rents up. But when landlords sell their properties, those homes flood the sales market, pushing prices down in some regions. So renters are paying more, while house prices fall. It's one of the most bizarre dynamics the UK market has ever seen. Former rentals now make up a huge proportion of listings, sometimes 1 in every 5 or 6 properties. These homes are usually well kept and in decent neighborhoods, and they're being snapped up by first-time buyers who were previously stuck renting. But despite the chaos, not every part of the market is suffering. Manchester, Bristol, and Glasgow are booming. Experienced investors are buying solid deals. Buy-to-let mortgage applications jumped 32% in early 2025, a shocking number considering how many landlords are leaving. These new investors aren't amateurs. They know the numbers. They plan for rate rises. And they see the current turmoil as a buying opportunity. The North, Midlands, and parts of Scotland are where the real value is. You can still find a 2-bed in Liverpool for under £120,000 that rents for around £800, a gross yield of 8%. Compare that to London. Spend £400,000 on a flat and maybe you get £1,800 rent, barely a 5% gross yield. After costs? Maybe 3% net if you're lucky. The South simply doesn't make financial sense for new investors anymore. But the North still does. First-time buyers are benefiting too. With landlords selling up, more homes are hitting the market, and many sellers are becoming flexible, sometimes desperate. Properties listed at £300,000 6 months ago are now quietly being reduced to £285,000 or £280,000. Buyers currently have the strongest negotiating power seen in years. Transaction levels have collapsed, down over 60% in some months. The market isn't slowing, it's frozen. Buyers are waiting for price drops, sellers refuse to budge, and with so few sales, prices appear stable only on paper. The Help to Buy fallout is another crisis. Many who bought overpriced new builds with 10 to 15% premiums now find their homes haven't appreciated or have lost value. A £250,000 flat bought in 2017 might be worth £230,000 today, leaving owners unable to sell or remortgage. Developers are still inflating prices, masking them with incentives like free fees or deposit boosts. Buyer confidence is low. Rates aren't falling fast enough. Banks aren't passing cuts to borrowers. So the market remains stuck. Looking ahead, analysts expect around 1% growth in 2025 and stronger gains after that. Savills forecasts 24% total growth between 2025 and 2029, with the North likely outperforming London. Rising wages and gradually falling rates should restore confidence and activity. The key point: the best opportunities exist now, while the market is frozen. First-time buyers with strong deposits can negotiate better than they have in years. Investors with capital can find real bargains if they do their homework and run the numbers.